Welcome to the deep dive.
Okay, so you've brought us quite the stack today. Looks like the unaudited financials and strategic updates for CanFin Homes Ltd. That's CFHL, right?
That's right, covering the second quarter and the half year ending September 30, 2025. So Q2 FY26, basically.
Got it. Q2 FY26. And our mission here is what exactly? To make sense of all this regulatory stuff.
Pretty much, we're going to cut through the jargon and the dense pages. We'll pull out the key bits from the filings, the investor slides, the press releases.
So you get the quick picture.
Exactly, a fast understanding of their financial health, where the growth is coming from, and what their game plan looks like for the rest of the fiscal year.
Okay, let's dive in then. Let's unpack this. Headline numbers first. They usually tell a story.
They do, and it's a story of, well, pretty decent growth here.
Right. Net profit after tax, the PAT, for Q2 FY26 came in at Rs 251 crore. That's up 18% compared to the same time last year. Pretty solid jump.
Very solid. And on the loan side,
Their loan portfolio grew too, 8% year on year. Hit Rs 39,657 crore by the end of September. And, looking at the half-year numbers confirms this isn't just a one-quarter thing.
Good point. What did H1 look like?
So for the first half of FY26, PAT was Rs 475 crore. That's a 16% increase over the first half of FY25.
Okay, so 16% for the half, 18% for the quarter. It shows good momentum, consistency.
Exactly. That consistency suggests, whatever's driving this performance, it seems stable, not just some quick win.
Absolutely. Which naturally leads to the next question. What is driving it?
Yep.
What levers did they pull? Was it just more lending, maybe riskier stuff, or something else?
That's the key question. And the filings suggest it was much more about efficiency and really interesting moves on their funding costs. Let's look at the margins.
Okay, financial health snapshot time. Margins first.
Right. So net interest margin, or NIM, that's sort of the core profit engine for a lender.
Yeah, what they earn on loans minus what they pay for funds.
Exactly. Well, their NIM for the first half improved. It went up to 3.83%. Last year, H1 was 3.65%.
Okay, improvement there. And the spread?
That widened too, up to 2.79% from 2.56% last year.
But wait a sec, you mentioned funding costs. I saw something interesting there. In this kind of market, you'd expect borrowing costs to be going up, or at least staying flat.
Usually, yes. That's what makes this stand out. Their cost of borrowing actually decreased.
Decreased, right?
Yeah. For the first half, it was 7.29%. Last year, same period, 7.56%.
Huh. How they manage that? That feels counterintuitive right now.
Well, this is where their strategy seems quite effective. It tells us they've been actively managing their liabilities, maybe shifting the mix of their debt, maybe finding cheaper sources, maybe negotiating better terms.
So they're finding cheaper money to lend out.
Precisely. And managing to do that while also increasing their NIM, that's pretty sophisticated financial footwork. It's not easy.
And it seems like they're keeping a lid on spending, too. The cost-to-income ratio for Q2, what was it?
Very lean, 18.55%.
18.55%. Wow, that's low, especially for housing finance, right? Staying under 20% consistently is often seen as top-tier efficiency.
Absolutely world-class. So you combine that cheaper funding with really tight operational control.
And the profits just flow through better.
Straight to the bottom line. And, that boosts shareholder value. Basic earnings per share, the EPS, jumped significantly. It was Rs 18.88 for the quarter.
Compared to?
Rs 15.88 in Q2 last year. So really nice increase. The whole engine seems pretty well tuned.
Okay, strong growth, efficient operations. But growth always brings up the R word, risk. Let's talk asset quality. Do they compromise on loan quality to get that 8% book growth?
Well, you always watch that closely with expansion. The numbers show they kept things largely under control, though there was a small uptick.
Okay, what are the NPA figures? Non-performing assets.
The gross NPA ratio came in at 0.94%. That's up just a touch from 0.88% last year.
And net NPA, after provision.
Also a marginal increase, 0.48% now, compared to 0.47% in Q2 FY25.
So slight increases, but still very low numbers for the sector overall.
Extremely low, yeah. Very healthy levels. But the really interesting part here is how much they're setting aside. They're provisioning.
Right, the buffers against potential future losses. How conservative are they being?
Very. Actually, exceedingly conservative. This is a key insight. So the rules require them to provision based on expected credit loss, ECL. That calculation came out to Rs 390 crore.
Okay, 390 crore required.
But they're actually carrying a total provision of Rs 495 crore on their books.
Whoa, wait. 495 crore? That's over 100 crore more than required? Why such a big gap?
It's deliberate, it signals prudence, maybe even a bit of caution about the future. That extra amount includes Rs 59 crore, specifically labeled as a management overlay.
Management overlay. What's that?
It's basically extra money the management has decided to put aside, on top of the standard calculated provisions, just as an additional buffer against unexpected shocks. Plus, there's another Rs 40 crore specifically for restructured loans.
So they're building a serious cushion above and beyond the rules. That's reassuring, I guess.
It demonstrates a very strong, sort of fortress-like approach to risk management.
Speaking of fortresses,
Yeah.
let's look at the overall balance sheet strength. Capital, liquidity. How does that stack up?
Very strong there, too. The capital risk adequacy ratio, CRAR, is at 25.58%, well above the regulatory minimums.
Okay, solid capital. What about ready cash, liquidity?
Now this number really jumps out. The liquidity coverage ratio, LCR, it hit an astonishing 217.24%.
217%. That seems incredibly high. Isn't the requirement something like 85%?
Exactly. The requirement is 85%. So yeah, 217% is massive.
What does that practically mean?
It means for every, let's say, dollar of potential cash outflow they might face, in a short-term stress scenario, they're holding more than $2 in high-quality liquid assets.
Okay, so they're swimming in liquidity.
Pretty much. It's not just about safety. It gives them immense flexibility. They're very well insulated against any sudden funding squeezes. And one more thing on the balance sheet strength. Their leverage came down. The debt-to-equity ratio decreased to 6.61. Last year it was 7.19. So less reliant on debt compared to their equity base.
Right. And I saw the auditor's note, too, confirmed they maintained 100% asset cover for their secured NCDs, non-convertible debentures.
Yep. And no breaches of any loan covenants on those listed debentures either.
So, clean bill of health there, strong capital, massive liquidity, reduced leverage, and operating within all their debt rules.
It's a pretty robust picture heading into the second half of the year.
Okay, let's pivot then. We know they're running efficiently, managing risk well, but let's talk strategy execution. Who are they actually lending to? What's the focus?
Their customer base leans heavily towards stability. The filings show that the salaried and professional segment makes up 69% of their outstanding loan book.
So nearly 70% are salaried folks or professionals, generally seen as lower risk, right?
Typically, yes. And product-wise, they're sticking to their knitting. Housing loans, including some construction real estate, account for 85% of the total loan book.
Okay, so core focus remains housing, mainly for salaried individuals. What about loan sizes? Are they targeting big loans, small loans?
Seems like the mid-market sweet spot. The average ticket size for new housing loans they approved is around Rs 25 lakh. For non-housing loans, it's about Rs 14 lakh.
Got it. And where are they doing this lending? Their reach?
They've got a wide footprint, 248 branches or offices spread across 21 states and union territories, so pretty broad geographical coverage.
Okay, broad reach. But how are they getting the business? This sourcing number really caught my eye, the reliance on third parties.
Yes, that definitely stands out. A full 79%, nearly 4/5 of their total business sourced in Q2 came through the DSA channel, direct selling agents.
Wow, 79% through DSAs. That's high. Effective for volume, I guess, but maybe costly, or adds a layer of risk.
It's a common model, but yeah, that's a very high percentage. It suggests a heavy reliance on external partners to bring in loan applications.
Which actually provides a really interesting backdrop for their big tech project, doesn't it? They must be looking to change that dynamic somewhat.
You'd think so. That high DSA number makes their IT transformation project seem even more strategically important.
Tell us about that project. What's the status?
According to the disclosures, it's moving along as planned. They actually ticked off some key milestones in Q2.
Like what?
They've already implemented several foundational systems, things like risk management tools, treasury systems, and getting their cloud infrastructure set up. Back-end stuff mostly.
Okay, foundations laid. But the big customer-facing and processing systems, when do those go live?
That's the next big step. They're targeting Q3 FY26, so starting soon for the rollout of the key components. We're talking about the new loan origination system, the LOS.
Which handles the application process.
Right, and the loan management system, LMS, for managing the loan lifecycle after approval, plus a new human resource management system, HRMS.
Okay, LOS, LMS, HRMS, those are core systems.
Yeah.
They should theoretically streamline things quite a bit, maybe drive more efficiency gains.
That's precisely the goal. These systems are designed to automate large parts of the lending process, make it smoother, faster, and potentially less costly.
And maybe, just maybe, Reduce that heavy 79% reliance on external DSAs over time, if they can handle more directly and digitally.
That would be a logical long-term aim, yes.
Yeah.
Build more direct customer capability.
Okay, one more area before we wrap up. To get the full picture, we should look beyond just the financials. Did they mention anything about non-financials, ESG, CSR, that sort of thing?
They did. The disclosures highlight a few initiatives showing they're trying to integrate ESG, environmental, social, and governance factors into what they do.
Like what specifically? Any new products?
Yeah, environmentally, they launched a new loan scheme specifically for rooftop solar panels on homes for systems between 3 kW and 10 kW.
Ah, okay. So using their lending power to push green energy adoption at the household level. Makes sense.
Exactly, and internally in their own operations.
They mentioned their corporate office and 16 branches are now using solar-backed UPS systems, uninterruptible power supplies.
Right. And all their offices have switched to LED lighting, small steps, but they add up to reduce their own operational footprint.
Okay. And on the S&C side, social responsibility, community stuff.
Two fairly significant environmental restoration projects were highlighted.
Oh, tell us about those.
One is an ecological restoration project in Kharsi village up in Uttarakhand. They're planting 2,500 trees there and building a pretty large rainwater harvesting pond, capacity of 1.1 million liters.
Wow, 1.1 million liters. That's substantial. A real community investment.
Definitely. And the second project.
Down south, in Sivagangai district, Tamil Nadu, they worked on reviving an old pond called Minachi Kulam.
Restoring it. Yeah, restore its water storage capacity back up to, get this, 5 crore liters. That's 50 million liters. Huge impact for local water security.
Impressive scale on both projects. Anything on their own workforce. Training, development.
Yes. They reported delivering around 30,000 hours of training, reached about 94% of their staff.
Covering what kinds of topics?
Key areas like ESG awareness, risk management best practices, compliance standards, the kind of continuous learning you need in finance.
Right. Okay, so let's try and tie this all together. We've covered a lot of ground. What's the big picture takeaway from this deep dive into CFHL's Q2?
Well, putting all the pieces together, it looks like CFHL had a really strong quarter and first half. They delivered solid profitability.
Driven by those improved margins,
Right.
And especially that ability to lower their borrowing costs against the market trend.
Exactly. That cost of borrowing piece is key. Plus, really efficient operations. And importantly, they did this while maintaining, even strengthening, their risk buffers, the high provisions, the massive LCR.
So solid performance, prudent management.
I think the main takeaway is how they seem positioned for the rest of FY26. They've managed this tricky feat of lowering funding costs while boosting NIM and having that incredible liquidity cushion, over 217% in LCR.
Which gives them a lot of firepower.
Immense room to keep growing the loan book, you'd think, especially as those big IT projects, the new LOS and LMS systems, start coming online next quarter. That should unlock further efficiencies.
Which brings us nicely to our final, maybe provocative thought for you, the listener, to chew on. We kept coming back to that huge 79% reliance on the DSA channel for sourcing business.
Yeah, that number is hard to ignore.
So here's the question. As CFHL rolls out these brand new digitally focused loan origination and loan management systems starting next quarter, systems designed for efficiency and potentially direct interaction, how is that 79% going to change?
Good question.
Will this new tech backbone finally allow them to shift significantly towards more direct, maybe digital sourcing? Could that be the key to further improving margins in the long run? Or maybe just reducing the risk that comes with relying so heavily on third parties?
It's definitely the big strategic question hanging over them now. Successfully implementing and leveraging that tech could really reshape their operating model, their cost base, maybe even their customer relationships over the next few years.
Something to watch, for sure. Well, we've done our deep dive into the numbers, the strategy, the filings. Now it's time for you to put this knowledge to work.